So you have Europe basically flatlining, a stagnant industrial economy, and huge project delays on the U.S. Gulf Coast. Yet somehow, Linde just flexed its pricing power to print a staggering 30% operating margin.
It is exactly what you want from an industrial gas monopoly. I mean, supply chains tighten up, and they just pass the surcharge right through to the customer.
Seriously, it is almost unfair. By the way, today is Friday, May 1st, 2026. We're diving into Linde, ticker LIN, and their first quarter results. And just a quick housekeeping note, this is not financial advice, just our personal opinions, so please do your own homework.
Always a good idea, especially since the tape today was, well, it was a bit exhausting. People forget the stock actually had a massive run through the quarter. It was up over 17% heading into the print. Then this morning it gapped up, peaked around 524, and then spent the rest of the day just slowly giving it back. It closed modestly green at 507.92, but that early excitement definitely washed out.
Right, a classic fade. But if you just look at the raw prints, it feels remarkably steady. Revenue came in at $8.78 billion, which is basically flat from last quarter, but up 8% year over year. And their adjusted EPS hit $4.33, up from $4.20 in Q4. So if the headline numbers look like clockwork, what spooked the morning buyers?
I think the market is looking past the margin and seeing some underlying friction. The CFO literally said they are not running on all cylinders right now. Sequentially, base volume growth was basically zero. The revenue stability you mentioned is purely from them hiking prices to offset weak demand. EMEA is soft, and their U.S. healthcare unit, which is usually bulletproof, is totally flat right now because of some late 2025 Medicare policy restricting equipment services.
Sorry, volume growth was zero? So they're squeezing all that extra profit out of a completely stagnant base? That is aggressive capital management.
It is, but they do have some hypergrowth masking the traditional weakness. Aerospace and electronics both jumped 10% year over year. They actually have over $1 billion in backlog just for advanced AI semiconductor fabs.
That is wild. And I was reading the call transcript. They're actually preparing to break out aerospace as its own reporting segment. They're literally pumping the propellants for commercial rockets.
Yeah, the logistics of that are honestly fascinating. In the early testing phases, Linde has to truck liquid hydrogen thousands of miles just to supply a single rocket test. It's highly inefficient. But once a space company scales up to regular commercial orbits, Linde transitions from a delivery service to an on-site builder. They just construct a permanent plant right next to the launch pad.
Oh, I love that. You literally cement your monopoly into the ground.
Exactly. They refuse to play the short game. It's the same thing they're doing with the current global helium shortage. There are supply shocks in Russia and the Middle East, causing spot prices to spike. Most companies would just gouge their customers today. Linde is ignoring the spot market and using the panic to lock new customers into strict multi-year supply contracts.
That's playing chess while everyone else is trading day to day. All right, let's actually get into the details on how this long game is flowing through their cash statement.
Yeah, the cash flow number definitely caught my eye there. Free cash flow dropped. It looks pretty brutal at first glance, down 43% sequentially to $898 million.
Which sounds like a red flag, right?
It sounds like one, but management noted it is mostly just typical first quarter seasonality. Paying out cash incentives, interests, early taxes. They still have a fortress balance sheet. I think the real story in the capital allocation is where their heavy infrastructure spending is hitting a wall.
Right, because they are still deploying, over $0.3 billion in capital expenditures this quarter alone. So what is actually stalling out on the ground?
Woodside. It is this massive clean energy mega project on the U.S. Gulf Coast. They're trying to build out these autothermal reforming and carbon sequestration facilities. The idea is to transition from gray hydrogen to blue hydrogen, but they're hitting real-world physical constraints. Labor is incredibly tight. Subcontractors are totally backed up.
So the grand green energy transition is basically stuck in a traffic jam of pickup trucks and backhoes on the Gulf Coast?
That is exactly it. And Matt White, the CFO, called it out directly. He said, let me find the quote. Yeah, he said, "The construction and subcontractor environment in the U.S. Gulf Coast remains challenging, and we have had some delays there."
Which pushes the timeline to when?
Well, the standard nitrogen phase is fine, but the really advanced stuff, the blue hydrogen components, those have slipped from late 2026 into the first quarter of 2027.
Wow, that is a noticeable delay for a project that size. But if they cannot find enough welders or specialized pipe fitters for Woodside, doesn't that threaten the execution of that entire $7 billion backlog they have?
It absolutely puts pressure on it. Building these facilities, especially the ones with high Nelson complexity ratings that interface with major refineries, it requires a very specific labor pool. And when you factor in compounding inflation over time, project delays like this compress your internal rate of return. The capital just gets tied up longer than expected before it starts generating cash.
Okay. Yes, but that is domestic friction. They're also taking hits from things entirely outside their control right now. I noticed in the annual filings, they're taking massive liability provisions for Russia.
Right, the joint ventures. Following the sanctions and the fallout with Gazprom, Russian courts actually allowed local entities to execute enforcement actions against Linde. 2 of their Russian joint ventures were forcefully seized and sold off.
Jeez. They just took them.
Linde's sitting on about $1.9 billion in liabilities logged specifically for terminated Russian agreements. They're pursuing arbitration in Hong Kong to recover damages, but practically speaking, collecting on that is going to be incredibly difficult.
It really shows the duality of this business. On one hand, you have this beautiful, predictable pricing model on a spreadsheet, and on the other, your foreign assets are literally being seized by governments, and your domestic projects are bottlenecked because you can't find enough people to pour concrete.
Physical infrastructure is unforgiving. You can surcharge a customer for inflation, sure. You cannot surcharge a missing construction crew or a geopolitical decree. You just have to eat the delay.
Fair point. So where does all this friction leave them heading into the rest of the year? Are they actually worried?
They are guarded. I mean, that is the exact word they used. They expect full-year earnings around $17.60 to $17.90.
Which implies what? Roughly 7 to 9% growth?
Right, but the tell is really how they structured the guide. They raised the bottom of the range by 20 cents because of their baseline resilience, but they left the top end completely flat. Matt White actually said, "It is just too early to signal increased optimism with so many things happening in the world." He wants a few more months to see how it plays out.
That is so aggressively Linde. Like, we are expanding margins and dominating the space market, but let's just plan for a mild apocalypse anyway.
It works. It is totally justified given the EMEA situation. But here's the real bright spot we should not overlook. You remember last quarter we harped on their massive $10 billion project backlog?
Yes, your whole stop building and start billing rant, and I remember.
Right. Well, it turns out they're actually billing. The contractual sale of gas backlog is now down to $7.1 billion.
Oh, wow. So they really chewed through it.
Exactly. So despite the Woodside delays on the Gulf Coast, they are successfully finishing other facilities globally and turning the cash registers on. The underlying engine is working.
Taking a step back then, this is exactly why people pay the premium for this stock. Europe is shrinking, construction labor is a mess, the helium supply chain is literally on fire in Russia, but they just quietly lock in long-term contracts and raise their earnings floor.
It is the definition of a fortress balance sheet. It's not going to double overnight. It's just built to survive whatever the cycle throws at it.
Built to survive and occasionally pump rocket fuel into space. I love it. I think that's a pretty good place to leave it for today. Thank you for walking through this with me, Miro.
Anytime. Always a pleasure.
See you next quarter, everyone. Goodbye. If you like having these earnings breakdowns just kind of show up in your feed, feel free to follow the podcast. Just a quick reminder, this whole thing is an AI-generated experiment, really just to see if language models can actually pull a human-sounding narrative straight out of dry SEC filings. We are always tweaking the format, so if you have a ticker you want us to dig into next, drop us a note at earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for listening.
Catch you next time.